This is take three. Um, yeah, fun times here. So, welcome to 2024, a new year of promise full of renewed hope, significant change, and hopefully an improvement in your financial strategy and progress in your journey towards financial freedom. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective, where I help you make your dream a reality. And like I said, it is the third attempt at making this video because and I would film these by YouTube Live, but I like showing my screen and need to show my screen. So Zoom it is. And at the same time, Zoom lately is a janky piece of work, but such is life. So third attempt, let's hope it works. Uh, our closed-end fund strategy is just one way we're working towards our dreams, working towards accomplishing our dreams. If you want the full methodology, so I use Kiyosaki's terms. So earned income, passive income, portfolio income. If you want the full methodology and how to make all those three or how to make those three things relate, then head over to Facebook and check out my group called Adaptive Perspective, Navigate Your Finances. I give you the whole thing for free. So reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I've made a few mistakes so far, and you're getting my sarcasm after two previous failed attempts. Thank you again, Zoom. I'm not a financial advisor. I am a financial strategist. I like all things strategy. And then I don't speak like the herd. I'm very much okay with that. I walk in limited company, and sometimes I walk alone, meaning I do my own thing against advice. We operate a self-managed closed-end fund portfolio, or CEF portfolio, on Webull that's built on lasting dividends and not the gradual sell-off of own funds. And that means the day-to-day, week-to-week pricing fluctuations don't bother me. They don't weigh me down. I've seen our portfolio go from plus 10% to minus 20%. And as crazy as the minus, like nobody wants to see their portfolio crash to minus 20%. That day-to-day, week-to-week, month-to-month swing doesn't really bother me because our overall value, our overall purpose in building the portfolio is not built on the swing, because it's not built on sell-off price. It's built on dividends. So, and that's very different than most market advisors. That's very different than most investors. So here are the components of that strategy. We play the long game, not like today, tomorrow. Sometimes 5 years. I mean, some of our holdings are meant to are hopefully sold on the short end of things, but long game, like 5 years, 10 years, 15, 20, maybe 30 years. I don't talk like, hopefully don't talk like the investment talk show circle junkies advice. I don't use it. And since the pandemic, since it's ending, we've learned the following about that guru advice. The 60-40 stocks, or I guess former guru advice, who are still out there gladly taking your money, building you a bad portfolio. That 60-40 stocks to bonds advice is dead. It's not built for lasting success in the current marketscape. The previous 4% withdrawal method is trash. The guy who invented that, the MIT grad, is now withdrawing more than 4%. So the 4% withdrawal method was built upon the hope that you would gain 4% in the market every year. And then you would take 4% out of the market every year, like you would sell 4% of your portfolio. So you have a net, like no loss system, but at the same time, you never have a gain. So that's faulty on a lot of levels. One, that's built on $1 million. And if it's you and a spouse, you're already losing. And not because your spouse, it's just your strategy's bad. So on your $1 million, you're 4% less on what you're taking out, hoping you'll gain 4% in the market every year. So you still have that $1 million. But it's not just the 4% withdrawal. I mean, 4% is getting eaten by inflation on a good year, right? Like on a good year, it's 4% inflation, not the last couple crazy years of inflation. Plus, who's living off of 4%? Take your job right now, whatever you're doing, even at entry level, blue collar, white collar, pick a collar management, like teaching, oil and gas, Kinder Morgan, industrial, pick your job. You're making more than 40 grand. So your $1 million portfolio at age 65 plus, you're suddenly going to go from making 80 plus grand to now living off of 40 grand. That's trash. That's a lie. So, like, seriously, I can't, I cannot fathom living on 40 grand a year. Just isn't it's not there anymore. So instead of that 40 grand, it's more like 80 grand, right? Because that would be about where you are right now. I mean, I'm 16 years into my current full-time job, and that's a little more than I make, but I'm going to make that so long as I stay in that full-time job. The goal is to get out of that full-time job, right? But 80 grand would be amazing to retire upon. So that's 8% withdrawal. And then you factor in the 4% inflation. Now you're looking at a 12% loss on the year. If it's you and a spouse, so that's 8% for you, 80 grand for you. That's 80 grand for your spouse. So now you're looking at a 16% withdrawal plus a 4% loss of inflation. So you're losing 20% of your portfolio's value if you're withdrawing it on that cycle every single year. So the portfolio that was designed to last you 25 years now lasts you 5 if the market works that way. But the market hasn't worked that way. So you kind of see why we have a lot of retirees retiring and then coming back to the workforce. They can't stay retired. They can't afford it because the strategy sucks. Now, I could say the old guard's playbook isn't working. And that's just polite because the strategy sucks. So instead of following that bygone strategy, we made our own. We began a no withdrawal portfolio that's designed to fund. I mean, ideally fund, if not, it will supplementally fund a retirement through dividends instead of the slow cash outs. So when we started, we took the advice of the contrarian outlook team. And while we've been on the journey, we slowly tweaked the system and made it our own. And we put greater restraints on and conditions upon what we're buying. And I'll get into that here in a little bit. Strategy wise, it's part buy and hold, and then it's part rollover. So if we sell something, we're not taking the money out, we're just rolling it into our next buy. We never pay a premium. Okay, now how serious is that? We never, ever pay a premium. We target obscene discounts. And we take historical data into account in order to improve that outcome. We target 9% plus dividends. Seriously, that's not the 0.5% crap you get with Apple. And I mean, let's be honest, if Apple's paying you a 0.5% dividend and inflation's 4%, you're really losing 3.5% on your investment every year. So instead of the Apple 0.5% method, we use our own, and we take Warren Buffett's advice when we do so. Okay, Warren Buffett has two quotes that I'll put here. He's been known to say you want to buy stocks for 66 cents instead of $1, which is his way of saying to buy closed-end funds because it's the only place you can utilize that market strategy. And diversification is not a good thing. Diversification is just a hedge against failure. We would much rather choose discernment over outright diversification because if you know Lord of the Rings or if you've watched the movies, or probably you've heard somebody say this, Bilbo at one point talks about feeling like butter scraped over too much bread. That's kind of like diversification. You're spreading your money over so much ground, you can't really make much, you can't make up or you can't make progress forward because your money is so spread out. Okay, we also take a Rothschild's advice, or at least I've seen it attributed to a Rothschild. I don't know if it actually is a Rothschild's advice or not, but it's when there's blood in the street, even if it's your own blood, you keep buying. The only thing I pay attention to on CNN is their fear and greed index, and it's this nice pendulum, right? But it generally it tracks market sentiment, but it tracks a couple things. So it tracks general investor sentiment, but it really tracks new investor sentiment. New investors are habitually late to whatever party. They pull their money out of the market really early when anything goes amiss, and they buy into the market really late when things have already been really good. But then it also tracks those circle junkies, those talk show motley fool circle junkies who are pumping fear into the market to control those new investors. Because when new investors pull all their money out of the market and the market drops, most those talk show junkies go, no, 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 don't buy right now. And that's the best time to buy. You buy in fear, and then you buy in extreme fear. And if you have to buy in greed, then you make darn sure you get a really good discount. So, how do we do all this? Let me show you. Uh, before I show you the spreadsheet, it's we're employing a specific strategy, right? That I've already talked about, and I'll show that here in a little bit, which is why I like Zoom over YouTube Live. So based on our strategy, where would I park money right now and why? Like if I'm buying tomorrow, where would I put my money? Now, when I say this, I'm making these videos to justify my own logic. I'm also making these videos to help you. And so you can see where I would be buying. You can see where I'm putting my money or where I'm putting our money. And at some point, I would like to market the the information contained in the spreadsheet, but at the same time, I'm not out to take your money and invest your money for you. My job is to help teach you and encourage you to teach yourself so that you can take control of your own finances and stop paying somebody else to do it for you. So if we look at the market at large, the Fed has stalled rates. And even with them stalling rates, the mortgage rate nationally overall fell 0.5%. That's pretty significant. So leading into this year, I've seen people predict anywhere from 3 to 6 interest rate cuts this year, which 6 would be crazy. Uh, and I don't think we'll see 6, but I mean, I would think that whatever we have, the first one would happen in April. So we see how the first quarter goes. April, the rate drops right before summer. That kind of sparks a moving frenzy because people move around a lot in the summer anyway. And if you've seen rates the last year, you don't want a new rate at 7.5. Currently, it's at 6.5. Maybe it'll drop a little bit closer to 6. So if you could walk away this summer with a house at 6 to 5.5%, that's a lot better than 7.5%. Plus, you've had a year to plan for that. And if that happens, it's going to spark. So like we have homes on the market now, we have surplus on the market. So that's driving the cost of those homes currently down. So as soon as the rates drop, we have the surplus. You're going to watch a lot of homes go quickly, and then that extra supply will dry out, and it will increase the the price of what's left. It'll also further increase a home value if you already have a home. Um, and I will say crazy political stuff tends to happen over the summer. So if there's a housing market surge and an interest rate drop, then the news will tend to focus on that and not focus on anything else they should be covering. So when it comes to oil, it's mixed. There's supposed to be a shortage. I mean, OPEC was supposed to cut cut supply, but no one really followed that agreement. So supply is still high, but at the same time, the U.S. reserves are low. So it's kind of a mixed bag. Um, that said, oil and its derivatives are more important in the U.S. and the U.S. energy landscape than anybody wants to admit. Whether that's wind farming, which is, we'll say it's a conversation for another day. But in order for that wind farm to work, you need oil. In order for your solar farm to work, you have to have solar panels, and those are made by oil. In order to watch your phone or watch a laptop or have a working fridge or have a pacemaker, all of that's oil based. So when the housing market speeds up and you have all these people painting, paint is an oil derivative, stain is an oil derivative, flooring can be an oil derivative. So to have production on the low and for whatever reason, energy overall still lagging with the Fed's pivoting. Um, if the housing market takes off and the Fed cuts rates, the oil market could explode. So with all of that in mind, of the people I read, nobody really knows what's going on. They have a lot of suggestions. Now, some people I listen to and a lot of people I don't. But if it's me, then I would give you two primary options of where to look, really a top four overall of where to look, and then some things of where I would not park money. So if I'm investing tomorrow, then I would look into energy infrastructure. So oil, utilities, energy transfer. Um, if I am, I would say I'm reading my notes with, uh, and yeah, I mean, I could pat myself on the back. I've been championing oil and energy infrastructure since October, uh, along with the people I read, but the market at large, advisors at large have stayed away from it. So if not energy infrastructure, then I would look at bonds and not just any bonds, but like bonds at discount. And then almost everything else, meaning business development, real estate investment trust, banks like preferred shares or convertibles. Uh, you could look at data and communications because that's like oil. Energy infrastructure is much like data infrastructure. Data infrastructure relies on oil production and the derivatives of oil production. But the hosting of cloud coverage and internet security, all that stuff is its own component. Now, you could factor it in with other consumer, but consumer as a whole group, like real estate is in consumer cyclical and data and comms and or data and communications and pick your consumer product is all wrapped inside consumer. And that as a whole is it's too big of a pot for me. So um, I think housing ought to be its own thing. I think technology ought to be its own thing and not wrapped inside consumers. So technology is still overpriced for me. Consumer as a whole, it's a pot that's just way too big for me. So my top four would be energy infrastructure, bonds, business development, REIT, or so real estate investment trust, banks, data communications, or I guess data communications is four. But um, yeah, all right. So enough of this. So let's get to the list, and this will make more sense, or at least come on. So this is our closed-end fund master. Somewhat move this out of the way. Um, the entire spreadsheet gets updated monthly, which means I just updated it this weekend. Everything in purple, green, or olive, purple, olive, and blue that gets updated weekly. Gray does not meet the parameters that are here. Purple is recommended by somebody I trust. Light blue is what we own. all of this, what we're interested in, and then I mark everything by targets. Now, before I say more, this triple alert is a buy alert. That means the current discount is either, well, no, it's not either anymore. It used to be either double the historical or greater than the 5-year discount. But I wanted to optimize our investment. Like, what are we really getting? Let's get the best deal we possibly can. So everything with a triple is both double the historical discount and greater than the 5-year discount. Dollar cost would be we already own it, but it's just below our average price. And then single is we're tracking for whatever reason. So as we come back in alphabetical order, this is what it looks like. But if we rank it by discount, we get a much better view. We own a few categorized. So like category 1 would pay 1, 4, 7, 10. Category 2, 2, 5, 8, 11. Category 3, 3, 6, 9, 12. A couple of them pay on an off cycle. Like we own a fund that pays 1, 3, 6, 9. That we're looking to sell, to be honest. So we own a couple funds here and there that are quarterly, but I've been attempting to prioritize monthly. So if we rank them by discount, I'm not interested in a one-time, like one-time year payment. This is consumer, built well, but it's consumer. This is new. It used to have a different title, but it's a little bit different structure now, and it makes the list. So I've already sorted the vast majority of these targets. So now it looks like this. So when I make these videos, I take the triple asterisks and I come over to the new tab. This is last week's. And we're going to do this. That'll go away. Current would be we currently own it. So all of these are significant. So we're going to buy discount, right? We're going to demand a discount and not pay premium. We're going to follow these buy alerts. So it's double the historical data, right? So this discount, so if you imagine break even at $1, like you're paying exactly what it's worth at $1, then getting it for 39 cents off or 39% off is like paying 61 cents instead of $1. So back to that Warren Buffett content or comment. So the historical discount is close to 15. The 5-year discount is at 22. It'll dip a little bit as this buyback happens, but that's kind of secondary data. But we're looking at this historical data related to its current discount. So based on that, even though that one's at 2.5%, it's still significant because it's relating to its historical data and not the field at large. So if it's me, and you remember those categories, so energy infrastructure, bonds, and everything else but technology and consumer, then we start to sort the list. Now, normally, I'm not into buying anything, at least what it has been. I'm not interested in buying anything we don't already have, but this, with its portfolio, will make the cut. But before we get that, all right, so all of these are significant. So now we can, going back, I'm working ahead. So we go by discount, right? We demand a discount. And not only that, we demand a significant discount, significant as it relates to each fund's historical averages or each fund's historical discount data. After that, we target by yield. So we want 9 or above. Excuse me. I always like a little cushion. Maybe not 1,000. Mm. So 9 and above. Normally, we're not buying or we're not including something we don't already own. Just it hasn't popped up. We already own a decent number of companies that pay decently. So whatever we would buy would have to be equal or better to equal, comparable, or better than what we already have. Um, but I guess before we do it that way, we can weed out by what the fund contains. So real estate, energy, utilities, bonds, that makes the list. Convertibles, that makes the list. This comes recommended by two different groups, but one I trust a heck of a lot more than the other. But it's like senior loans and private loans, private lending, uh, and bonds. Gabelli is tempting. Mario Gabelli is well known. It's a brand association. It pays a consistent dividend that has not risen recently. They pay a special dividend occasionally, and it's not normally this low. I mean, it's generally at a premium and a significant premium, but it pays quarterly. So compared to and say he's got like top 100 countries, blue chip companies. It's that diversification thing. Of what we own in blue, we don't have a portfolio built like this one. But but most of what we have that pays right, like 6 cents and better, like it's if it's paying monthly, this is going to out earn Mario Gabelli at 0.077 times 3 months, right? Paid quarterly. If I'm buying it for just the dividend, it's not always going to be what you think it is. Um, but again, I've been targeting monthly, so it's going to have to go. This is a. It's been reported that it's a junk bond fund, and junk bonds are junk bonds, and I don't like buying junk. Uh, it's much easier to clear out um, what we don't have and then go through what we already do have. But this is off that, say, non-monthly. This is monthly. It comes recommended, but at the same time, I try not to buy 16 or over. So that leaves us with what we own in blue and then these general trackers in green. Um, the past several videos, I've not been interested in buying something we don't already own. But part of this is curious or noteworthy. So we'll go ahead and clear these out. Now, of what we already own, and I'll go ahead and type these in. We don't own the ones in green. These are how many shares we already own. I love this fund. Pays a great yield based on its cost, but it's one of the lower yields. But it is all business development companies. We don't plan on adding any more of that right now unless the price significantly drops out. Now, it is it's it is energy infrastructure. It is the energy infrastructure fund. Uh, Pays well. It's managed well. It's a rising dividend. I have no idea what that was upstairs. It's a rising dividend. It just merged with its sister company. They're supposed to raise dividend. They're supposed to raise the dividend by a cent, which is not going to do a huge thing, uh, but it doesn't meet the target need of monthly. Uh, this has been an inconsistent tech fund, but one, it's tech. It's kind of oversold. Two, that inconsistent dividend, like fluctuating dividend, has not been my favorite thing in the world. So that leaves us with the monthly stuff we have and then monthly options here. So bonds, bank, private lending, and bonds, that's tech. Um, consumer funds. So we're still screening, right? So based on needs. So tech. So we're looking at energy infrastructure, bonds, and we're looking at business development, uh, data, communication, cloud management, real estate investments. That does not fit the need. This tech, computer, right, does not fit the need. This one is a different type. It's the CBRE brand. It's real estate. And now we're kind of splicing hairs. So the top two are bonds and energy infrastructure. And then after that is everything else. So we could try to find a fund that has a mix of those things, right? But that's just energy infrastructure. That's real estate, just real estate. Um, this is just private lending. I'll put it back. This is banking, and they're great funds, um, but it's not the others. So bonds, private lending, real estate, energy, utilities, bonds. That's kind of a mix of everything. And then you have this one, which was off the radar until about 40 minutes before I made this video. And what I pulled up, so what I had been doing was trying to hit 200 shares of the funds that we were keeping long term. And everything that we had been at 200, unless it was just an amazing deal on top of the already amazing discount. I was targeting, like I was using this system. So the discount and the yield plus whatever we had to invest, and then making the best decision based upon whatever we had to invest. Uh, I get before even that. So it's that filtration system, right? So it's the discount based on historical data, the targets, the yield, sifting out the funds based upon the established parameters, energy infrastructure, bonds, business development, real estate investment trusts, data communications, uh, banking based, right? And then mixing out technology and general consumer platform, right? And that leaves us with this. So I had been, like before I discovered this, I would have told you if you don't own a closed-end fund, the best place to start is always with the greatest discount. It's a sustainable dividend. It's a well-run company, and the discount actually closes like in the last 2 months. It's closed almost 10%. As has that one. It's risen a little bit, but it's closed dramatically, and it could still close, and you could still get an amazing deal. And my suggestion was, well, I was just going to pick this one, do 50 shares there, right? It increases us to 200 overall. Problem solved. What's next? But then I saw this. And if you remember the order of things, it's energy infrastructure and then bonds at a close second if you can get a really good deal. And then the other things. And that's an energy infrastructure account. So if it's apples to apples, it's pretty close. Like you're paying more for it. You're getting a slightly better dividend. You're getting a slightly better annual payout. This one has a slightly better yield because it's based on the dividend divided by the cost. So it's comparable. It comes down to what you have to invest. So I like to buy things in sets of 50. I like the strategy of that. It makes it easy math. When KYN merged with its sister company, it was not a straight one-to-one transfer ratio. So it left us with like 373 shares. So I bought the filler amount and then rounded it to 400 because I like sets of 50. It just makes it easier math. In this, the TEAF fund uh, is a good option, but I cannot afford it at a set of 50. So if you're brand new to closed-end funds, I would tell you to pick the best discount. But even before that, I would tell you to know your strategy. Like know your strategy, where you want to invest, how you want to target, what you're looking at. Are you buying to diversify or are you buying to actually target and implement a strategy? Diversification would be like, well, heck, we'll just buy 50 shares of everything. But maybe everything isn't good. Maybe everything isn't good long term. Now you could say maybe one of these funds, maybe this fund would be great for 6 months. Okay, well, in 6 months, we would love to have it sell higher, collect a dividend along the way, and then sell it, and then swing that money forward into another investment. But that's energy infrastructure. That's like all of these are long-term holds. Um, so if you're brand new to closed-end funds and you know your strategy and you're still looking for advice, I would tell you to pick the best discount. Bonds, private lending, great long term. If you want that, but you want a little bit more diversification within fund, so bonds, energy, real estate, utilities, great for the market now, great for the market forward. Um, that's this. If you want energy infrastructure that's going to be now the market forward and 40 years down the road, that's this. Like I can argue for all of them. It comes down to affordability. I cannot afford this. I can afford the top two. But since I've been looking to even that out, that would be my pick. So we'll say, um, yeah, I'm going to leave these blank. Um, so if it's me, it's here. If it's you, then you need to know your strategy. Um, if I had, I mean, we can play, if you had your druthers, say if I had this amount of money, what would I do? I would do this. Okay, and then this is what we have total. So I would buy this, right? But this is the dividend we have. That's the dividend we gain. Um, right, but I don't have $1,200 right now. Maybe if we sold some funds, maybe. Um, but of our portfolio, which is here, um, we own one, where we go, two, three. Yeah, we currently own three energy infrastructure funds. Only one of those meets the discount parameters and the strategy. Um, one of those three of the other, like this is the only one that hasn't increased its dividend since the pandemic. Now we're ahead. I don't know at what point when we would sell it. Um, but the other two have increased their dividends. They're still rising into what used to be their dividends. Um, another consistent, another consistently paying monthly oil and gas or energy infrastructure fund dividend would be a good thing. Now, the Circle guys would say, wait. Of the 21 funds you own, four of those are oil based. You want to diversify. Well, they can say that, but I'd rather target investments. Like it's Warren Buffett's advice. I'm not diversifying to diversify. I'll diversify based on strategy, based on need, but I'm not going to diversify just to diversify. Oil and gas, whether you like it or not, is going to be in the need from now till whenever this world ends. It's so much of our lives, so much of our economy is built upon oil. So to say I'm not going to make oil at all, then you're going to have some problems. Um, so another monthly oil payer, energy infrastructure fund payer, would be a great thing now and a great thing long term. In the coming bond market, with the Fed pivoting and potentially lowering rates, either of these are great. But even if they maintain the same rates, either of these are great. And then again, we're not selling these funds. Like we have some funds earmarked for sale, but not these. Um, the goal would be that, I mean, whenever we sell them years from now, or whenever our kiddo sells them years from now, they would be higher than what they currently cost. But again, the goal is the portfolio funded by dividends and not the selling off of the portfolio. It's a very different strategy. It's a very different long-term strategy. Um, so any of these three, I could argue for any of these three. I could argue any of these three against the other two. But for us and where we would be investing tomorrow, it's what I have shown. If we had a different amount of money to invest tomorrow, I mean, we could play what if games all day, but the what if scenarios are not reality. So based upon our reality, that's the best strategy for us. If the money changes, which maybe it will, like maybe we'll sell those two funds, and then the next video I do, we'll have a different amount of investment available, and we'll play that strategy when and if it happens. But for now, this is the best strategy for us. So based upon your strategy, pick the best strategy for you. I will attempt, there we go, attempt to stop the share. So those are my top selections for the week, as well as my top selection for us this week. If you like the content, consider subscribing to my channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances. As you face the year, like I've said all this past year, as you face the year, you need to know where you're going and why. And if you um, envision that scenario as you piloting your own ship, that metaphor works well for me, right? So captain your ship. Your boat will go wherever you steer it. So you better make sure you know where you're going and why. And if you have no idea what I'm talking about, then come find me on Facebook. Uh, look at the system, look at my free files, and I get into the why of your journey. And we talk about dreams and goals. And if that still doesn't make sense, then ask me a question or send me a message and let's talk and let's get you going. So whatever you have planned for 2024, whatever you know is happening, I hope it goes well. And for all the unknown of 2024, I hope it goes well. But you got to know that not everything's going to go well. So know your strategy, know your purpose, know the reason behind it all, so that when something just goes to crap, you still have that forward thought, that forward sight at the horizon, that you can make it through what you're going through because you know where you're going. So captain your ship, and whatever you have going, if it could have happened on its own already, it would have happened on its own already, but it's not going to happen on its own. So make it happen. If you want to end up in a specific place, then it's on you. Make it happen. So this is Daniel Young signing off. I will see y'all on another video. If you want to connect, find me on Facebook and just search Navigate Your Finances. So Happy New Year, happy 2024, and see you again shortly. Bye bye.